afternoon, depending on what time zone you're on, to the monthly truck stop webinar presented by the Motor Carriers Insurance Education Foundation and the Transportation Risk Specialist. This is Tommy Ruke. I welcome you here. For a few of you all know that I had my hip replaced last Monday, and let's know I'm doing well. As you have been, we publicize, we do these webinars every second Thursday of every month, and we try to bring topical subjects to you and reach out to individuals who can add to expertise and add direct to expertise into our other resources. Next page, Tom.
All right, Beth, I'm sorry, but I'm not changing here.
If you have any,
I'll keep clicking it there, Tommy, but I'm not. There we go.
Go back one. If you have any questions, there on the right-hand side of your control panel, there's a chat window. Write those questions in. During the webinar, we'll stop and ask Tom, our presenter, those questions, or later, if you want to email them to us, we will respond by email. We'll do this, and when we respond by email, when you email them to us under the website which says Ask Tommy, those then get published or get shared by everyone. So we like to take the ones that are generic in nature to be able to do this. For you who want to review this later or share it with other people in your office, or even in this particular case with some of your insureds, this will be available to be downloaded from our website shown here, transportationriskspecialist.com, under the truck stops. I want to introduce you to Tom Dickmeyer, a long-term friend of mine. We were sitting in a seminar that was done by another party in Indianapolis a couple months ago, and Tom had been a part of this starting of our Motor Carriers Insurance Education Foundation, and we were talking about how he could help us. Tom has had a long-term and unique relationship with the trucking industry, both the American Trucking Association or their insurance task force, and in the truck carriers the truck Carriers Load Association too. And because of his relationship with those people, we have developed an alliance, and we're working towards providing sharing information with those entities, which will give us, we hope, highlights to the trucking industry itself, the need and the importance of doing business with insurance agents and insurance carriers who understand the motor carrier industry. Out of this discussion, Tom mentioned as always, a bunch of insurance truckers were talking about stuff about non-trucking liability. He mentioned that he was just at a leadership conference in the American Trucking Association, and they asked him to do a white paper on Bobtail non-trucking liability coverage and considerations on their behalf. I said, Tom, that's a great idea. What are you doing on July the 11th at 2 o'clock Eastern Time, and would you mind sharing that presentation with our membership? So this is not only shared for us, but also this is also being shared with the American Trucking Association and their membership too. To that end, Tom, I welcome you here. Tell me a little bit about yourself, and we'll go from there, buddy. Thank you for being a part of this today.
Thank you, Tommy. I'm glad to be here, and I will hope that I do better with the presentation than I've done so far in changing the pages. I'm having a little technical issue here, so hopefully that's over with. But I'm happy to be here, and I appreciate everyone that's joined us to listen in on what I think is a pretty interesting subject today. Bobtail coverage and independent contractor liability issues is our title, and I've been in the insurance business about 35 years. About 25 of those years have been spent almost exclusively in trucking. So I've seen a lot of issues with regard to Bobtail and independent contractor liability, and I think it's an important coverage, and these issues are important. So I've been looking forward to sharing this with you. So we'll get right into that. Pop 2. Okay, today we're going to focus on liability coverage issues for those independent contractors who are under permanent lease to motor carriers. I think it's important to get the verbiage straight right off the bat and know that we're not talking about the owner-operators with their own authority who haul for different people under their own authority. These are independent contractors who are typically most of the time under the motor carrier's authority to whom they're permanently leased. You know, the motor carrier's liability is going to cover the operations of these ICs whenever they're operating in the business of the motor carrier. The trick, as you'll see as we go on, is to define when that is. When is that independent contractor operating in the business of the motor carrier, and when is he actually using his tractor for his own use or personal use? So the first question is, why would independent contractors carry liability insurance? The genesis of the request from ATA to do a white paper on this issue was rooted in a pretty strongly held opinion by a number of the folks there that Bobtail insurance almost never covers a claim. That in fact it always is pushed back and reverts to the motor carrier's liability. So that's where this thing started, and the question was, why should we carry this liability insurance? And there's really two paramount reasons. One, the independent contractors typically are required by the motor carrier to carry this insurance and provide proof of this by a certificate of insurance. It's part of the operating agreement usually. Second, regardless of the prevailing opinion, the independent contractors do actually operate their units for non-business or personal use, and they need to protect themselves. And as you'll see as we go along here, there are cases where an independent contractor will be operating his vehicle and get into an accident, and that accident will be found to have been his liability and have nothing to do with his motor carrier relationship, and he will need this coverage to respond in that instance. Okay, so here are the issues that we're going to focus on. First, what is Bobtail and what isn't? We're going to spend a little bit of time on terminology there. We're going to talk about the three separate types, the main types of independent contractor liability and what they do and don't do. We're going to spend really a considerable amount of time on the dangerous truth about non-trucking use coverage forms, what you need to be aware of when you're dealing with non-trucking use coverage. We're going to talk about when an IC liability policy does apply to a loss, and those instances when it does cover a loss. And then we're going to spend a few minutes on knowing all of this, how do we minimize the exposure to the independent contractor and the motor carrier alike. Okay, let's start with what is Bobtail. Bobtail is a generic term. I know I use it. I'm sure a lot of you use it as well when you're describing the liability that the independent contractor carries. It's used as a generic term to describe all of it, when in fact true Bobtail liability is actually a specific coverage form that covers an independent contractor when he is operating without a trailer attached. It's not as widely offered as it has been in the past. It is available periodically and in a few companies, but you don't see a lot of it. It is generally more expensive than the non-trucking use forms when you can find it. But it does have some advantages, and we'll talk about those in a little bit. But the Bobtail, true Bobtail coverage doesn't really matter whether the independent contractor is operating under dispatch for or for the benefit of the motor carrier or in the business of the motor carrier. None of that comes into play. The criteria is that there's no trailer attached. So one of the advantages of Bobtail coverage is if you're insuring like a drop and hook operation, and that motor carrier can demonstrate that a bunch of their IFTA miles are being done by tractors with no trailer attached, the Bobtail insurance can cover that particular exposure, and those miles can be negotiated, at least with an underwriter, sometimes successfully, to pull those miles out of the motor carrier liability exposure base. So there's some tricks you can use if you can find Bobtail that might make the more expensive feature of that worthwhile. Okay, having said that it's not all Bobtail, let's talk about the three types of liability coverage. The first of those is the true bobtail, which we just talked about. There's a coverage form called unladen liability, and then there's non-trucking use liability, which we're going to spend the majority of our time on today. Unladen liability applies whenever the independent contractor is operating without cargo. If there's not a load on the truck, then unladen liability would apply. So it covers when there's no trailer attached, just like bobtail, but it also covers when there is a trailer, but the trailer's empty. So similar to bobtail, unladen is going to cover regardless of whether the independent contractor is operating under dispatch or for the economic benefit of the motor carrier. It's just the only requirement is that no cargo is being transported. So for that same reason, like bobtail, unladen is generally more expensive than non-trucking use liability. Again, if a motor carrier can demonstrate that it tracks those miles that are unladen, which most of them do, it's part of their operating model. Sometimes you can have some success in negotiating those miles down on the exposure base that the underwriter is using for the motor carrier liability exposure. Okay, Beth, are we getting any questions so far?
Nothing so far.
Okay, good. The third type is the one, like I mentioned, that we're going to spend the majority of our time on today, and that's non-trucking use liability. And it's referred to as NTU or NTL or just non-trucking liability. But this coverage depends on whether the independent contractor's operation at the time of loss fits the definition in the policy. And the definition in the policy may refer to and depend on the language of the independent contractor operating agreement that's in place with the motor carrier. So whereas the bobtail and the unladen, there's a physical definition, no trailer, no cargo, that's pretty simple and pretty clear, pretty straightforward when it comes to a claim. Here you have to refer to policy language, what's covered, and is there a referral within the what's covered definition to what's going on within the operating agreement. In the past, some of these policies, most of them, the triggering language was tied to the independent contractor operating, quote, under dispatch, unquote. And so you still hear a lot of people talking about claim issues and those issues revolving around whether that independent contractor is under dispatch or not. Very seldom anymore is that included in the language of the contracts. There was so much loose room for interpretation within the under dispatch wording that the underwriting companies came up with what they feel like is better triggering language than under dispatch. So you don't see that very much. What you do see more now are policy languages saying in the business of, or for business purposes, or operating for the economic benefit of the motor carrier, those types of things. So here's the dangerous truth about non-trucking. Here's the thing that I think is probably the most important thing that you want to take away from this session, and that is that there is no truly standard coverage form or language. There may be policies that are very similar. There are endorsements that are standard endorsements that can be attached or not attached. But if you're dealing with non-trucking use liability, the first thing you should think of is that I don't want to assume I know what's covered here until I look at this policy. So you have to closely examine the policy to determine when coverage will apply. Even more dangerous, some insurance companies have different forms of non-trucking liability. So if you go through the XYZ insurance company form today and you have a handle on what that policy says, and you pick up an XYZ policy tomorrow feeling safe in your knowledge that you gained yesterday, you could be getting yourself into trouble. And there are two reasons for that. Some of them have different forms, and they'll use one form for one type of risk and one form for another type of risk. Or the underwriting criteria may push them towards one type of form more so than the other. But the other thing that we see is that each state may have statutes in place that force different language for states. So you could have one insurance company, again the XYZ insurance company, that has several different policy forms with different language for several different states, and so you need to know what state you're dealing with, and you need to read that form specifically. So you almost have to go to every single individual policy you get and go through that policy and review what that language is that triggers coverage, and make sure that you're comfortable that that's going to work for the exposures that your client has. As you look at these policies and this triggering language, what you'll see is that there's a wide array of wording and how much wording as well. So that there is, I can tell you there is one company that has 2 sentences that describe what's covered, and there's another company that has 2 full pages, and I don't know what the font is, but I know it's not 12 or 14, it's little font. So, you know, there's just a huge variety of wording when it comes to these coverage language triggers. Tommy, anything you want to add there?
No, we're fine, thank you.
Okay.
The ISO endorsement is 2309. And that's the quote that you did earlier, Tom, where it says used in the business of the person you're leased to.
Right.
But most of the carriers that you're dealing with here take the 2309 endorsement from ISO and modify it and put their own language in as you are spelling out here.
Right.
There are 2 major differences in this, looking at different carriers, that I find a concern, Tom. And the first one is, when are you in the business of who you're leased to? This is where the wording that you just came up, that you mentioned, non-trucking, under dispatch, laden, under directions come in place. But the other one here is the need to have a lease in place to make the non-trucking coverage effective. Standard ISO does not require a lease to be in effect with the motor carrier the independent contractor is leased to, where there are some carriers, you know, out there that has the wording in it that the coverage for non-trucking is only afforded when the insured, the independent contractor, has a lease with a motor carrier who is assuming the primary liability while the vehicle is being operated. And that's the wording that you have to be concerned about. I want to talk later when we're through this. I mean, at the end time, we got time about the importance to make sure that our insured is leased to somebody. But you want that as an underwriting consideration, in my opinion, not a coverage consideration.
Okay. Good. Good. And yeah, and we're going to talk a little bit about. We mentioned that there's a tie between the operating agreement and the coverage language in some of these policies, and we'll get into that. The issue that I mentioned spurred the request by the ATA to do a white paper on this was basically an opinion that these losses are almost never covered by the independent contractor's policy. They're always pushed to the motor carrier policy. Of course, the concern with that typically is that the motor carriers may have a deductible, whereas the independent contractor policy generally does not. And so when these things push into the motor carrier, a lot of times it's coming out of his deductible and coming out of his pocket. So it's a little sensitive as to which policy should apply.
Do you also find some? Do you also find some sensitivity where the motor carrier is forcing their owner-operator to buy this coverage, yet the owner-operator is coming back and saying, "I'm paying for it. What am I paying for?"
Yeah, yeah. I think there's a lot of that. I think, you know, it becomes difficult, and as you'll see, I think we've got an example in here where you've got a truck driver who's going to get his truck washed, and there are many cases like this where there's been an accident while that's going on, and depending on the state, depending on the policy, these things are the same circumstances are decided both ways. And so it's very hard to come up with clear-cut examples to say, when you buy this coverage, this is the type of thing that you're covering against. It becomes hard to come up with a hard and fast example. So it does, and it's very frustrating, and especially when the loss is quite large and the deductible is quite large that the motor carrier has. So let's talk a little bit about when an independent contractor policy does cover a loss. Again, based on the definitions, the bobtail and unladen forms are pretty much straightforward. They'll pay a loss whenever the IC doesn't have a trailer, or in the case of unladen, whenever he doesn't have cargo. So, you know, most of the disputes and confusion involve a non-trucking use form of IC liability. That also happens to be the most prevalent a type of liability that's sold these days. There's very little bobtail and unladen being sold out there. Much of what you do see in bobtail or unladen is being done by large motor carriers who have a in-house program that they offer to the independent contractors that lease onto that motor carrier, and it's not available typically to motor carriers outside that motor carrier, or to independent contractors outside the motor carrier. Okay, non-trucking use policies do cover losses whenever the circumstances of the loss conform to the language of the policy. One example we can talk about is a policy that covers whenever the independent contractor is not operating for a business purpose. So let's say your truck driver, your independent contractor, decides to take a date out in his truck. She likes big trucks, and he's going to make a big impression, so he gets his truck all washed up and takes her out on a date. That's a good example of a clear-cut example of where the independent contractor policy would apply. Now, I mean, just logic tells us that since the independent contractor operates most of the time in the business of the motor carrier, it stands to reason that most liability claims are normally going to go to the motor carrier's liability policy. But there are a couple of other reasons why it seems to an awful lot of folks in the industry that non-trucking use policies almost never do pay a loss. And here are the reasons. Many of the policies, the independent contractor liability non-trucking use policies, have very restrictive coverage definitions. Many coverage definitions are open to interpretation, leading to inconsistencies in the way the claim is handled. You'll get a group of trucking folks together, and they'll be talking about claims that they've had, and two of them have had identical claims, and they were decided different ways. It's not unusual. And then the language in an IC operating agreement can significantly narrow the coverage definition as well. So that if I go back a slide here and say that we're talking about a policy that, let's go back 2 slides. An example being the policy that covers whenever an independent contractor is not operating for a business purpose. As Tommy mentioned, when you get to defining what is a business purpose, it may refer at some point into the operating agreement that the independent contractor has with the motor carrier. And for example, that independent contractor operating agreement says that the tractor has to be kept clean, or the independent contractor has to maintain a neat appearance, then an accident while you're on an off-duty trip to the truck wash could be, and definitely has been, considered business purpose. And that pushes coverage to the motor carrier's liability policy. Okay? And there are many claims just like this, and it's important to know that some of those claims have gone to the motor carrier's policy, and some of those claims have been paid by the independent contractor policy, and some of that depends pretty closely on what the independent contractor operating agreement says. Okay. So having said all this, let's say we don't read our policies and we sell this, and we've got a non-trucking use out there and so forth. What's the worst that can happen? And if you've been doing this for any time, selling trucking insurance, you've probably been through this, where both the non-trucking use policy and the motor carrier policy deny coverage. Each of them determined that the other should pay the claim. And that can be very devastating to a motor carrier or to an independent contractor or both. You end up with a claim, and you've got, you know, an injured party out there, and this is the kind of thing that can drag a claim out long enough to maybe get an attorney involved where there might not have been one otherwise. And that is your worst scenario. Tommy, I'm sure you've been called in to talk about those types of things.
Yeah, it usually goes, Tom, and the court cases that I have seen start with always insuring the motor carrier, because at the time of accident, that's the high visibility entity, meaning their name is on the side of the truck. Their TIN number's on the side of the truck, and they're the big dog in the fight. Most people seeking recovery much rather go after the big bad motor carrier than this neighbor independent contractor who might own one truck. So what ends up happening is that the motor carrier gets sued, and then the motor carrier's insurance companies invokes or brings in the non-trucking liability coverage and saying, whoa, this truck was not operating on our behalf, therefore we're not responsible for it. Then the non-trucking policy needs to respond, and they would try to defer the coverage or push the claim down to the non-trucking policy.
Right, right. So that brings us then to knowing all of this. How do we minimize the chances that we're going to have an issue? And first and foremost, and this is my opinion, that if you have access to a bobtail or unladen policy, it may be worth the higher premium to choose these forms. Now, for those of us who spend our lives with these trucking companies, we know that every dollar is precious, and it's very, very challenging for them to look at two products that satisfy, you know, most of the criteria that they're trying to satisfy, one being higher price than the other, and for them to pick the higher priced policy. I think it's up to us to explain to them the advantages and maybe bring up some of these examples of specifics that are pretty easy to find on the internet.
Tom, let me ask you this.
Yeah.
In your discussion with motor carriers doing this, though, if in fact there's less liability from the motor carrier, are they willing to share or give a little revenue back down to the independent contractor because they've got relief under their own coverage, either from a premium standpoint or a reduction in exposure because of having a large SIR?
Yeah, I think there are some ways that you can approach that. You have to be very careful, obviously, that the motor carrier isn't starting to knock a dent in the arm's length relationship. That's very, very important here. But there are ways you can set the operating agreement up and the revenue splits and so forth that can make that work. There are also some ways that you can maybe help if you have a large enough group of independent contractors and your motor carrier is in good shape financially. There are some ways you can utilize a captive or a risk retention group or something along that line to put a little program together that allows the motor carrier to subsidize that pricing. They can buy even a higher deductible type thing and pay one rate and charge a different rate, as long as they're the insurance company, as long as all this is properly disclosed in the agreement and so forth. So there's some ways to do it, but I would be a little careful with for example, having them tell the independent contractors it's going to cost, X for this, but we're going to pay 30% of it because we're going to get some of the money back. I think that's got some issues with it. So it's probably something you and your motor carrier need to talk about the best way.
I was more I was more in the line of saying that if you bring non-truck or non-laden liability, then your percentage of the load that we will give you is X dollars. If you don't, it would be X dollars.
Yeah, I think that's
more in line of what I was talking about. Then obviously there would be a criteria of the coverage that's needed to meet the unladen requirement of the motor carrier to satisfy they have reduced their exposure, and so the policy that would be issued would have to meet that criteria.
right.
But if it does, then the motor carrier is pushing some of their liability down to the independent contractor, who should be compensated for that assumption.
Yeah. No, I agree. I think that's a good way to do it. And there's at least one motor carrier that requires, I believe it's unladen liability, and it's very specific in the operating agreement how the, how that policy language has to read in order to be acceptable, in order to be an independent contractor for that motor carrier. And I'm sorry, go ahead, Tommy.
Well, I was just saying, for people who are not familiar with the term of unladen, because you're dealing in a lot of our people on this program are with insurance carriers who use the standard endorsement or their endorsement, and
right.
agents who have not had experienced this. One of the things Tom mentioned, that the trucking companies keep pretty good records of their mileages, and one of the records they keep of their mileages are mileages that are unladen, meaning mileages that they're hauling and basically get no revenue for, meaning there's no load on that truck during these miles. And so you can back into what is a rate for the exposure for unladen, because you take, for example, and Tom, please correct me if I'm wrong, but take a reefer operation, you're talking about 8 to 10%
right.
of the time a reefer operation will not have a load on it. So if you take a premium desire of $5,200 and you're unladen 10% of the time, right. then to pay for the primary liability premium using that factor, then $520 plus a policy fee and all would cover that additional exposure for being unladen. So there's ways to actually actuarially back into that. Again, most motor carriers have records of their miles and unladen, and there's industry standards like, again, 8 to 10% for reefers, 12 to 15% for dry vans, 18, 19 for tankers. You know what I'm saying? You know the numbers, Tom, that
right.
depend on how successful they are for backhauls and
right.
things like that.
Yeah, and I think, don't assume that you're going to get that from the underwriter, but, in a softer market with an underwriter who's anxious to write some business, you can be real successful in giving him that method to reduce his rate and gain a piece of new business, for example. The current underwriting kind of marketplace is probably a little less conducive to those type of negotiations. But if you can clearly demonstrate in a compelling way that an underwriter can document in his file that he has no exposure for that percentage of miles, then you're going to have good luck, I think, trying to get some reduction in that rate.
And the point I was making, that most motor carriers have those records, pretty detailed records.
Yep, they do, and it's a big part of what they do. I mean, a lot of truckers will tell you that, their success or lack of success depends completely on their percentage of miles loaded. You hear the term deadhead, which is synonymous with unladen. It means you're running the truck, but you don't have any cargo. You're going from place where you dropped off the last one, and you're empty until you get to the place where you pick up the next load. If it's possible, here's tip number 2. If you can do it, it's always best to have the non-trucking use liability coverage with the same underwriter that has the motor carrier's liability. That, if you think about that dispute we mentioned earlier, potential dispute where the motor carrier liability denies coverage, and so does the independent contractor's liability. When it's the same underwriting company, you have a lot better luck getting somebody to step up and sit down and talk the thing through and figure out who's going to cover that. The challenge to this, obviously, is that the non-trucking is being purchased by the independent contractor, and the motor carrier can't tell that guy what to buy. He can tell him what format he has to have in order to satisfy the operating agreement, but he can't tell him where he has to go to buy it. So what you try to do is encourage it with making it reasonable rates. You try to maybe make the payment terms easy, maybe relax the deposits, those types of things. There are ways to encourage the independent contractor to select that underwriter. Probably the most important thing is make sure that this should say you and your motor carrier and independent contractor understand the language of the non-trucking use policy. If nobody in the mix knows what's covered or why, that's a recipe for disaster. If you have to start getting up to speed when the claim happens, you're probably going to keep running behind that curve for the entire duration of the claim, and that's not going to be good for anybody. And again, that's important for both the motor carrier and the independent contractor. So I've left some time for questions and answers. I want to just run through the conclusions quick, and these are the takeaways. It's critical to know the differences among those forms. What is bobtail? What is unladen? What is non-trucking use? And the next time you're talking about these things, if you've been using bobtail all along, you can keep using bobtail. Most of us do, but just be aware that there is a true bobtail policy that's different than an unladen or a non-trucking policy. Remember that when you're talking about non-trucking use policies, there really is no standard. Be afraid. Be very afraid until you read that policy and know what's covered. A lot of us are very busy, and it's not unusual for us to go out to a new customer with a proposal that has proposal terms, but it doesn't have specimen policies. That's not as popular a thing to do as it used to be years and years ago. In the case of non-trucking, if you're going to be working with a new prospect and you're going to be proposing non-trucking, my recommendation would be that you get a specimen policy along with all the endorsements and attachments, and review that before you go out so that you know. Otherwise, what's included in that underwriter's proposal to you or his quote to you may not be fleshed out enough for you to really know what that triggering language is all about in there. And obviously then know your client's policy, know what it covers before you get the claim call. It's just like baseball. I'm sure for all of us who played baseball, you remember one of the first things you were taught was know what you're going to do with that ball before it comes to you. If you don't, and the ball comes to you, and then you start thinking about what you're supposed to do with it, it's going to be a little bit too late. And that's the theory here. And then remember the ways that you can minimize the chances of an issue coming up over independent contractor liability.
Tom, there's
back here. Go ahead, Tommy.
No, I'm sorry. Go ahead.
I was just going to jump back and say, these are those ways to minimize.
Right. I'm sorry. Okay.
So
there's a couple points I want to add here. First off, for you underwriters or agents who write in New York, basically everything we said does not hold true in New York. New York has a special 2309 endorsement, and basically what it says is if there's no primary insurance in place, then the non-trucking will pay. So be very careful writing non-trucking where the policy is issued under the New York forms and the New York regs. It's going to be a little different. Second thing is, a lot of times the non-trucking is not bought monoline, meaning just auto liability. It usually includes physical damage and uninsured motorists. In fact, in looking at most of the claims, a lot of the claims, there is probably more claims paid out of uninsured motorist coverage than there is out of true non-liability coverage under the non-trucking liability part of the coverage itself. So in providing this coverage, you need to be very careful in the selections of the limit to make sure that you have met the state requirements of coverages for that uninsured motorist, underinsured motorist selection that's required in your state. thirdly, in the scenario that Tom gave you, where you have a claim and both carriers, meaning the auto liability carrier for the motor carrier you're insured is leased to and the non-trucking liability carrier both deny claims, this would have to end up sorting out with one exception. And because if the motor carrier's liability carrier is basing their claim on the vehicle is not being used on behalf of the motor carrier, the non-trucking liability insurance carrier is denying claim based on it was being used on the behalf of the motor carrier. Well, as we all know in the classes that we have been through and that we have taught, if there's a 91X in place and an MCS 90 in place, then the non-trucking, then the liability carrier for the motor carrier who is used an independent contractor would have to pay if at the accident time it was found that the non-trucking, the independent contractor's vehicle was being used on behalf of the motor carrier. So therefore eventually it would have to be paid. But there is a gray area there of the resolution trying to sort those two things out. And in most of the time I agree with you, Tom, that the reason they bring this up is there's a retention involved in the liability coverage for the motor carrier, and their TPA who are handling their claims are saying we don't want the claim, we're denying that claim and attempting to push it back. But eventually if the resolution of the claim comes out and in fact the vehicle was found it was being used on behalf of the motor carrier, then the motor carrier's policy would have to step up. Or if it was found that the vehicle was not being used on behalf of the motor carrier, then of course the non-trucking policy would have to step up. The only exception in the gray area here would be if the non-trucking liability policy has that wording in it that requires at least to be enforced to affect coverage for the non-trucking liability. That would be where there could be that gray area, because now you've violated a condition of coverage, not a situation where coverage is afforded. So that would be, that would be where you would have to worry about that gray area, Tom.
Yeah, and that's a great point, Tommy. The thing to remember is the other shoe will drop right behind that, which is subrogation.
Right, back against the retail agent and for any note. The last thing I want to mention, I'm in a court case right now involving this, and Tom started off referring to this in his first discussion. We're not talking about an independent contractor who owns their own truck and operates as themselves. So often for retail agents who don't understand the trucking arena, somebody's called up and says, look, I'm getting the trucking business. I haven't started working yet. I need insurance coverage. And what they're thinking of when they start with is non-trucking liability. You don't start there. You start with primary auto liability coverage. The only time that you would offer or go to a non-trucking liability or one of the other two areas that Tom just referred to in the unladen and if not, you got a real gap in coverage there. Yeah. And I know of a couple times I've had it, unfortunately, where the truck was just trying to get out of the dealership's yard, and somebody writes a non-trucking policy on it, and there's never a lease put in place, and the vehicle is now being used, could even be for hauling for themselves or private goods or things like that. That becomes a major gray area. So you'd want to make sure the lease is there and they're leased with a motor carrier who is going to assume that liability when the vehicle is being used on their behalf. That would be a consideration that I would want to add into it too, Tom. Other than that, that's pretty much where we want to go with it, Tom, and I think you did a great job, and I appreciate your time.
Thank you, Tom. I enjoyed it, and hope everybody got something out of it, and has, obviously, you have the ability to go back and refer to this on the website, I think, as Tommy mentioned.
Right, And if you have questions and answers about it, or follow-up, or other comments about it, please let us know, and then we will can address those on our Ask Tommy on our website. Again, y'all have a good afternoon. Tom, thank you for your time and effort, and we're out of here.